Welcome, everyone. I am absolutely thrilled to have you here for this explainer. Today, we're going to completely demystify a phenomenon that honestly baffles millions of people. Why the stock market is ultimately driven by human psychology and not just numbers on a screen. If you've ever felt totally overwhelmed by the chaotic swings of the market, well, you're in exactly the right place. We're going to break down the hidden emotional currents that actually drive those swings.
Okay, let's dive into this. Consider this explainer your personal survival manual for navigating market cycles. We are going to quickly cover 1. Why investors lose money. 2. The investor emotion cycle. 3. The VIX fear gauge. 4. The 4 predictable market stages. And 5. Real-world market indicators you can spot every single day.
Section 1. Why investors lose money. We really need to talk about the painful reality of retail investing. 80%. That is a massive number, right? Studies consistently show that more than 80% of individual investors underperform the broader market. And look, it's not because they aren't smart, and it's certainly not because they didn't do their homework. You can literally read every earnings report available, but the real reason people lose money is much more predictable. It's human nature. They consistently do the exact opposite of what they should. Every time the market gets scary, they sell. And every time the market looks absolutely unstoppable, they buy.
And this brings us to a really fundamental misunderstanding. The myth out there is that investing is purely a math problem. That if you just crunch the numbers perfectly, you win. But the reality? Investing is actually a psychology test. The core problem for that 80% of underperforming investors isn't a lack of math skills at all. It's the absolute failure to manage the two most overwhelming human emotions, greed and fear.
Which brings us to Section 2, the investor emotion cycle. Now, what's really interesting about this slide is this chart, the investor emotion cycle, is the most important chart you will ever study. Not because it shows you stock prices, but because it shows you where 80% of investors are emotionally at each point in the cycle, and why they keep making the same mistakes. Let me walk you through it. At the beginning of a bull market, investors feel optimistic. Things are getting better. Smart money is quietly buying. Then, as prices rise, excitement builds. Then thrill. Gains are accelerating. Then euphoria. The market is at its peak. This is where maximum risk is disguised as maximum safety. This is where most retail investors finally buy in at the worst possible price. Then something triggers a sell-off. Anxiety sets in. It's just a correction, they say. Denial. But it keeps falling. Panic. Then capitulation. The last desperate sellers throw in the towel at the very bottom. This is maximum fear disguised as maximum danger. And this is exactly where maximum opportunity lives. Then slowly, hope returns. Then relief. Then optimism again. The cycle repeats. Every single time.
I really want to isolate those two most dangerous extremes on that timeline because it explains exactly how our brains trick us. Euphoria feels incredibly safe because of herd mentality. Everyone around you is making money, the news is relentlessly positive, the economy looks bulletproof, so retail investors feel perfectly comfortable putting their life savings to work. But it is actually maximum risk disguised as maximum safety, because at that point, the market has nowhere to go but down. Conversely, capitulation, when everyone is just throwing in the towel, looks like a financial apocalypse. It feels incredibly dangerous to put your money to work when every single headline is screaming about a crash. Your stomach is literally in knots. But that isolation, that absolute bottom, that is actually maximum opportunity disguised as maximum danger.
And this is exactly why Warren Buffett's golden rule is so legendary. Be fearful when others are greedy, be greedy when others are fearful. It sounds so simple in theory, right? But psychologically, it's incredibly hard to execute. Going against the crowd just feels inherently wrong to our deeply ingrained human instincts. There's evolutionary comfort in the herd. But acting against that crowd, having the sheer discipline to sell during euphoria, and the absolute courage to buy during capitulation, that is the ultimate key to wealth.
All right, Section 3, the VIX fear gauge. Let's look at how we actually measure that fear.
So, we know emotions drive the market, but how do we actually measure something as abstract as fear or greed? Enter the VIX, or the Volatility Index. Think of this as the market's ultimate data-driven fear gauge. When institutional traders get scared about a potential crash, they go out and buy financial insurance using options contracts. It's kind of like buying hurricane insurance when you see a massive storm forming on the radar. The more insurance they buy, the higher the VIX goes. When they're complacent and confident, they don't buy that insurance and the VIX falls. It's literally a real-time thermometer for market anxiety.
So here's how to actually read this thermometer. It's like a cheat sheet.
When the VIX is below 15, we're looking at extreme complacency. Caution is totally warranted here because the market might be overheated and completely blind to risks. Now, 15 to 25, that's your normal business as usual range, just the standard hum of the market. 25 to 35 indicates elevated fear, so you should watch closely as healthy corrections play out. But the absolutely crucial point is that last zone, a VIX above 35. That is the panic zone. When you see this, history tells us it is a massive signal to prepare your capital to buy.
And this brilliantly illustrates exactly why that panic zone is so important. During the terrifying depths of the 2008 financial crisis, the VIX hit 80. If you bought in at that exact moment of maximum panic, you saw a 60% return over the next year. During the 2020 COVID crash, when the world literally shut down, the VIX hit 65. That led to a massive 70% return for those brave enough to step in. Even in the 2022 rate hike panic, a VIX of 38 preceded a 26% gain. Massive fear reliably produces massive opportunity.
Moving right along to Section 4, the 4 predictable market stages.
Let's move to and see how this builds. Now that we know how to measure the fear, let's step back and look at the structural mechanics of a crash. Every major reversal basically follows this exact 4-stage roadmap. Stage 1 is the bull peak. This is pure euphoria, incredibly high stock valuations, and smart money is quietly heading for the exits. Then, Stage 2 is the snowball effect. A negative catalyst hits, panic selling begins, and automated margin calls force even more selling. It just rolls violently downhill. Stage 3 is the bottom or capitulation. It's right here, amidst maximum fear, that central banks and governments usually step in to stop the fire. Think stimulus checks or drastic rate cuts. And finally, Stage 4 is the recovery, the light at the end of the tunnel. The smart money rides this wave back up long before the general public is ever convinced it's safe to invest again.
Finally, Section 5, Real-World Market Indicators.
Let's bring all these concepts directly into your daily life. You know, you don't always need to be glued to a trading screen or checking the VIX every 5 minutes to know where the market is. The best signals are often right outside your front door. When the market is in euphoria, what do you see? You see packed, incredibly expensive restaurants on a random Tuesday night. Your Uber driver is enthusiastically giving you stock tips, and free get-rich-quick investment seminars are popping up every single weekend. It's complacency at its absolute peak. But contrast that with depression signs. You'll see what's called the lipstick effect, where people completely stop buying big-ticket items like cars, and they shift to small, affordable luxuries like a nice lipstick or a fancy cup of coffee. You see mass layoff headlines everywhere, and honestly, most tellingly, there is complete and utter silence about stocks at dinner parties. Nobody wants to talk about their portfolio. That silence, that is your absolute loudest buy signal.
So I want to leave you with a really provocative question to ponder today. Step away from your computer, take a walk, and just look around. Based on what you see in your city right now, the conversations you're overhearing, the spending habits of your friends, the media headlines, what emotion stage is the market currently in? Is the crowd in euphoria, or are they in panic? Once you can answer that, you'll know exactly what you need to do next. Thanks so much for joining me for this explainer, and keep observing.